What if you knew one of Wall Street's biggest players was quietly getting ready for a huge move in an asset most people have forgotten about? JPMorgan, one of the largest banks on the planet, has put out research forecasting a major potential surge in the price of silver. They're not just throwing darts at a board. Their analysis suggests a massive supply shortage is about to collide with a boom in demand from green technology. In this video, we're breaking down JPMorgan's thesis and showing you exactly how you can position your portfolio for what could be the biggest silver run in a generation. When a financial giant like JPMorgan talks, savvy investors tend to listen. We're talking about a massive bank with its finger on the pulse of global markets. Their commodities research team has gone on record with a forecast that sees silver potentially being pushed towards 38 per ounce in 2025. This is not some wild guess. It's a projection rooted in a fundamental analysis of our rapidly changing world. But why should you, a personal investor, care what a Wall Street behemoth thinks? Because when an institution of this size signals a big move, it often points to a deep structural shift in the market. They aren't just day trading. They're making long-term strategic bets based on powerful underlying trends. Ignoring these signals is like trying to sail through a storm without bothering to check the weather forecast. The core of their argument is elegantly simple and incredibly powerful. It all comes down to two massive forces that are converging to create what looks like a perfect storm for the silver price. The first is a severe and deepening structural supply deficit. For several years running, the world has been using more silver than it mines and recycles. This isn't a one-off blip. It's a chronic imbalance that's draining global stockpiles at an alarming rate. The second force is an unprecedented explosion in industrial demand fired up by the green energy revolution. Every solar panel, every electric vehicle, and the 5G and AI infrastructure that is powering our modern world has a huge and non-negotiable appetite for silver. So you've got a situation where supply is getting tighter, while demand isn't just growing, it's accelerating. This is the classic recipe for a dramatic price jump. In this video, we're going to dissect both of these forces. First, we'll explore the why, the inescapable logic behind this coming silver boom. Then, I'll get into the how, a practical guide on the different ways you can invest and position yourself to potentially profit from this monumental shift. Let's start with the most critical and often misunderstood part of the silver story, the supply. The term supply deficit might sound like dry economic jargon, but what it really means is that for every ounce of silver we pull out of the ground, we're using up more than an ounce. The silver market has been in a structural deficit for several years in a row, a situation that has gotten more intense recently. Think of it like a family that constantly spends more than it earns. For a while, they can dip into savings. But eventually, that savings account runs dry and things get messy. That's what's happening to the world's silver stockpiles. The combined shortfall since 2021 alone amounts to a staggering figure, with some analysts putting the cumulative deficit at over 678 million ounces. That's a massive amount of silver that has been permanently removed from available inventories just to satisfy demand. Now, you're probably asking, if the price is going up, why don't mining companies just dig up more? This is where silver's quirky production reality comes in. It's a crucial piece of the puzzle. An estimated 70 to 80% of all silver isn't mined on its own. It's a byproduct of mining for other metals like copper, lead, and zinc. This means that the global silver supply is largely inelastic. It can't just ramp up when the price gets hot. A copper mine isn't going to spend billions of dollars in a decade on a new project just because the price of its secondary metal, silver, has popped. Their main focus is the price of copper. As a result, even as silver demand skyrockets, the supply pipeline stays frustratingly rigid. We simply can't turn on a silver tap to meet the world's growing needs. This inflexibility is made worse by other real-world mining challenges. We're seeing declining ore grades in major mining regions, meaning miners have to process more rock to get the same amount of silver they did a decade ago. Getting a permit for a new mine is a long, difficult, and expensive process, often taking over a decade. On top of that, political instability in key silver-producing nations adds another layer of risk to the supply chain. So we have a situation where existing mines are struggling to keep up, new mines are incredibly difficult to bring online, and most of the supply is tied to the economics of totally different metals. This pressure on the supply side is relentless. It's a slow-moving crisis that has been draining the physical inventories held in vaults in places like London and Shanghai. We have seen inventories in major trading hubs like the Shanghai Futures Exchange hit their lowest levels in nearly a decade at times. This isn't some theoretical problem for the future. It's happening right now. The shelves of the world's silver pantry are getting barer every single day. This is the ticking time bomb under the silver market, and it sets the stage for the second, even more explosive part of the equation, the demand tsunami. If the supply deficit is the kindling, then the explosion in green technology demand is the gasoline being poured on the fire. Silver is no longer just a monetary metal or something for your grandma's silverware. It has become a cornerstone of the 21st century's biggest technological revolutions. Its unique properties, specifically being the most electrically and thermally conductive element on Earth, make it absolutely irreplaceable in many of the world's fastest growing industries. Let's start with the biggest consumer, the solar industry. Every single photovoltaic, PV, solar panel uses a silver paste to conduct the electrons generated when sunlight hits the cell. There is simply no cost-effective substitute that can match silver's efficiency, and the demand from this sector is mind-boggling. A decade ago, solar demand for silver was just a fraction of what it is today. Now, it's a primary driver of global consumption, accounting for well over 200 million ounces per year and growing. As the world races to meet renewable energy targets, the push for more solar panels creates a ravenous, non-negotiable demand for physical silver. Next, let's talk about the electric vehicle, EV, revolution. A lot of people are surprised to learn that EVs contain way more silver than the gasoline cars they are replacing. Silver is used all over the place in electrical components, from battery management systems to complex wiring and heated windshields. Every EV that rolls off the assembly line uses more silver than the car it replaces, creating a powerful multiplier effect on demand. Projections show automotive silver demand is on track to climb significantly through 2025, making it a key driver of growth. But the story doesn't stop there. The rollout of 5G and the massive infrastructure build-out for artificial intelligence are also incredibly silver-intensive. Data centers, high-end semiconductors, and the millions of connected devices that make up the Internet of Things all rely on silver for its top-tier conductivity and reliability. And unlike investment demand, which can change with the wind, this industrial demand is sticky. A company like Tesla or a solar panel maker doesn't really care if the price of silver goes up 20% or 50%. The amount of silver in their products is tiny compared to the final cost, yet so critical to how the product works that they will pay whatever it takes to get it. They are price-insensitive buyers. What we're witnessing is a fundamental rebranding of silver. It's shifting from being mainly a precious metal to being a strategic industrial metal that also happens to have a history as money. This isn't a cyclical boom that will just fade away. The outlook for the green energy transition suggests it's a multi-decade megatrend. The adoption of EVs and AI is still in its early stages. This creates a baseline of industrial demand that looks set to grow relentlessly for years, if not decades. This is the second pillar of JPMorgan's thesis. A constrained, inelastic supply is smashing head-on into a structural, non-negotiable, and accelerating wave of industrial demand. This is the fundamental imbalance that points toward a significant repricing of silver in the very near future. Now let's bring this all back to you and your wallet. This whole supply and demand story is powerful, but it's happening inside a much larger and much more turbulent global economy. For the average person, the last few years have been a masterclass in financial anxiety. The biggest pain point for most of us is the nagging fear of inflation. You feel it every time you go to the grocery store or fill up your car. Your hard-earned money just doesn't stretch as far as it used to. This is the problem of currency devaluation. When governments and central banks print unprecedented amounts of money, the purchasing power of each dollar, euro, or pound inevitably goes down. This is where silver's ancient role as real money snaps back into focus. For thousands of years, long before central banks or digital dollars existed, gold and silver were perceived as ultimate stores of value. They can't be printed into existence, and their supply is naturally limited. This makes them a powerful hedge, a form of financial insurance against the steady erosion of your wealth. But it's not just inflation. We live in an era of profound economic uncertainty. Interest rate policies are constantly shifting, geopolitical tensions are on the rise, and the whole global financial system feels a bit more fragile than it used to. In times like these, tangible assets start looking really attractive. Silver, which you can actually hold in your hand, offers a sense of security that a stock certificate or a number on a screen just can't match. This is the dual-engine appeal of silver right now. On one hand, you have this explosive growth story driven by its indispensable role in green technology, which gives it the potential for huge gains. That's the growth part of the equation. On the other hand, you have its historic role as a safe haven asset and an inflation hedge, which provides a defensive wealth preservation side to your portfolio. It's this unique combination that is drawing so much attention from major institutions like JPMorgan. They see an asset that is not only set up for growth from industrial use, but one that could also see a massive wave of investment as more people seek shelter from economic storms. This dual nature makes silver one of the most compelling investment ideas of our time. It simultaneously addresses the fear of being left behind by a tech boom and the fear of watching your savings get eaten away by forces you can't control. We've just covered the fundamental reasons why Wall Street is getting so bullish on silver. It's a complex topic, and if you're finding this breakdown valuable, do me a quick favor and hit that subscribe button below. My goal on this channel is to demystify the markets and give you the knowledge you need to make smarter financial decisions. Subscribing is the best way to make sure you don't miss our future deep dives. Okay, that's the why. So how do you actually get in on this? So now that we get why silver could be heading higher, let's break down how you can actually invest in it. We're going to cover 3 main methods, each with its own pros and cons. That way you can decide which approach or combination of approaches is the right fit for you. The first and most traditional way to invest in silver is to buy the physical metal itself. This means owning silver bullion in the form of bars and coins. For many, this is the purest expression of ownership. The biggest plus of physical silver is that it's a tangible asset you hold directly. It's real, you can touch it, and most importantly, it has no counterparty risk. If you have a 1-ounce silver coin in your hand, you don't have to worry about a bank failing or a brokerage going under. That ounce of silver is yours, completely outside the digital financial system. In a world of increasing systemic risk, that's a powerful feeling of financial control. When you go to buy physical silver, you'll mainly see 2 types, coins and bars. Coins, like American Silver Eagles or Canadian Maple Leafs, are made by government mints and even have a face value. They're easy to recognize and very easy to sell. Bars can range from small 1-ounce pieces all the way up to huge 1,000-ounce bars. Generally, the bigger the bar, the lower the premium you'll pay over the raw price of silver. However, owning physical silver does have its challenges. The first is cost. You will always pay a premium over the spot price of silver. This premium covers the cost of manufacturing, shipping, and the dealer's profit. It's really important to shop around at reputable dealers to make sure you're getting a fair price. The second challenge is storage and security. Storing a few coins at home might be easy, but as your stack grows, security becomes a real concern. You need to think about a high-quality safe, or consider paying for third-party storage in a professional vault, or a bank's safe deposit box, which adds to your overall cost. Finally, selling it isn't always as easy as other methods. While silver is highly liquid, turning a large amount of physical metal back into cash is not as simple as clicking a button in your brokerage account. It means finding a dealer and arranging the sale. For those who value direct ownership above all and want a hedge against financial system meltdowns, physical silver is often the top choice. It's the bedrock of a precious metals portfolio. If the idea of storing heavy bars of metal in your house sounds like a total hassle, then our second method might be more your speed: silver ETFs or exchange-traded funds. Think of a silver ETF as a way to own a piece of a massive pile of silver without ever having to touch it. An ETF is a fund that trades on the stock exchange, just like a share of Apple or Microsoft. The fund's managers take investor money, use it to buy huge 1,000-ounce silver bars, and then store them in secure, audited vaults in places like London or New York. When you buy a share of the ETF, you're buying a claim on a tiny fraction of that giant silver hoard. The main advantage here is convenience and liquidity. You can buy and sell shares of a silver ETF instantly through any standard brokerage account. The transaction costs are usually very low, and you don't have to worry about paying high premiums, storing the metal, or insuring it. It's the easiest way to get direct exposure to the price movements of silver. The most well-known silver ETF is the iShares Silver Trust, ticker symbol SLV. It is the largest and most traded silver ETF in the world. Another popular option is the Aberdeen Standard Physical Silver Shares ETF, ticker SIVR. These funds are designed to track the spot price of silver, minus a small annual management fee called an expense ratio. However, ETFs aren't perfect. The main criticism is counterparty risk. When you own an ETF, you don't actually own the silver. You own a share in a trust that owns the silver. You're trusting the fund's custodian and managers to securely hold the metal that backs your shares. While these are highly regulated firms, it's a layer of trust that just doesn't exist when the metal is in your own possession. For investors who want quick, easy, and cheap exposure to the silver price and are comfortable with the ETF structure, they're an excellent tool. It's a way to play the silver market with the same ease as trading stocks. Our third method for investing in the silver boom is maybe the one with the highest potential for both reward and risk: buying stocks in silver mining companies. The best way to think about this is the old saying from the gold rush: you can pan for gold or you can sell shovels. Investing in silver miners is like selling the shovels. You're betting on the companies that are actually pulling the metal out of the ground. The key concept here is leverage. These companies' profits are leveraged to the price of silver. Let me give you a simple example. Let's say a mining company can produce silver at an all-in sustaining cost of $20 per ounce. If the spot price of silver is $25, their profit margin is $5 per ounce. But if the price of silver rises 20% to $30, their profit margin doubles to $10 per ounce. A 20% jump in the silver price can lead to a 100% explosion in the company's profitability. That's the kind of math we like to see. This leverage can lead to explosive gains in the stock price, far bigger than the gains of the metal itself, The pros are clear. The potential for outsized returns is massive. If JPMorgan's forecast is on the right track and silver starts a sustained bull run, well-run mining companies could see their stock prices multiply. Plus, some established miners pay dividends, giving you a stream of income. However, the leverage that gives you all that upside also creates serious risk. When you buy a mining stock, you're not just betting on the price of silver, you're also betting on the company's management, the political stability of where their mines are, their ability to control costs, and their luck in finding new deposits. A mine could flood, a government could seize assets, or their exploration could come up empty. Any of these company-specific problems could cause the stock to tank, even if the price of silver is soaring. You can generally break down mining stocks into three groups. You have the majors, which are large, established producers with mines in different countries. Then there are the mid-tiers, and finally the juniors, or explorers. Small, highly speculative companies searching for the next big discovery. The juniors offer the highest risk and the highest potential reward. For investors with a high risk tolerance and a desire for leveraged returns, mining stocks are an exciting way to play the silver thesis. But it requires more homework and a strong stomach for volatility. No investment guide is complete without a frank discussion of the risks, and it's critical to go into any investment with your eyes wide open. Building real wealth isn't about finding a sure thing. It's about understanding and managing risk. First and foremost, you have to understand that silver is a notoriously volatile asset. While the long-term trend looks incredibly positive, the path upward is almost never a straight line. Silver is known for its sharp, gut-wrenching price swings. You have to have the emotional strength to ride out those down periods without panic selling. If you're looking for a smooth, steady ride, silver might not be for you. Second, it helps to watch the gold to silver ratio. This is simply the price of gold divided by the price of silver, or how many ounces of silver it takes to buy 1 ounce of gold. In the modern era, this ratio has often averaged in the 50-to-1 to 80-to-1 range. When the ratio gets very high, say 90-to-1 or more, it can suggest that silver is undervalued relative to gold. Watching this ratio can give you some context, though it is by no means a perfect crystal ball. Third, you should be aware of the long-standing concerns about how the silver market works. For years, many investors have raised red flags about the influence of large banks and the paper derivatives market on the silver price. While the fundamentals of physical supply and demand we've talked about are powerful, the paper market can sometimes create price movements that seem disconnected from physical reality. This is a known risk in the precious metal space. Finally, let's have a reality check on price targets. JPMorgan's research suggests silver could be pushed towards $38 as part of a catch-up trade. You may also hear more speculative targets of $100, $200, or even higher. While it's true that the structural deficits could potentially lead to a market mania or a squeeze that drives prices to wild levels, it's important to separate a reasonable forecast from a blue sky scenario. Position your portfolio based on the strong fundamental case and think of any potential mania as a possible but not guaranteed bonus. A diversified approach, maybe a mix of physical metal, an ETF, and a few good mining stocks, can help you manage these risks while still giving you plenty of upside exposure. So let's bring it all together. The case for a major repricing of silver is one of the most compelling investment stories in the market today. It's not built on hype. It's built on a solid foundation of market fundamentals, recognized by one of Wall Street's most powerful institutions. You have a structural supply deficit that's been building for years, where the world is consistently using more silver than it can produce. At the same time, you have an explosion of non-negotiable industrial demand from the unstoppable megatrends of green energy and advanced technology. This collision of shrinking supply and expanding demand creates a powerful updraft for the silver price. On top of all that, you have a shaky global economy, where silver's ancient role as a safe haven asset and inflation hedge becomes more attractive by the day. It is this rare combination of a defensive store of value and an offensive industrial growth asset that makes silver's potential so immense. We've walked through the why and the how, from the physical metal you can hold in your hand, to the convenience of ETFs, to the leveraged potential of mining stocks. The right path for you depends on your own financial goals and your tolerance for risk. If you found this guide helpful and want to keep learning how to navigate the markets and build long-term wealth, make sure you're subscribed to the channel and have hit the notification bell. That way, you won't miss our next video. And now I want to hear from you. After hearing the case, what's your preferred way to invest in silver? Are you a physical stacker, an ETF trader, or a mining stock speculator? Let me know your thoughts in the comments section below. I read every single one. Thanks for watching.